So in this video, we're going to break down exactly why I trade gold. We're going to break down exactly what I've been doing during this uncertainty. I'm going to take you through the charts. I'm going to take you and have a look at some of the macroeconomic factors, and we're going to help you understand exactly how, when these times of uncertainty come around, you can make big profits. Gold is traditionally a safe haven asset, and that is why, as a trader and an investor, I've been heavily focused on gold in my portfolio over the last 30 years. More specifically, I also trade gold in the forex markets, and the thing to understand about gold is that it traditionally is a safe haven asset. Whenever there is any war on the horizon or any level of global uncertainty, you generally find that most investors head towards gold as a safe hedge in their portfolios and their assets. Now, obviously, this year, gold has broken all-time highs, and last year was consistently breaking all-time highs, and we've seen gold spike as high as $5,600 an ounce this year, and obviously, since then, the price has retraced quite a bit. A lot of developments geopolitically this year, in addition to the volatility driven into the markets by Donald Trump and his administration, with a lot of uncertainty around trade, economics, and obviously the global macroeconomic picture. We, of course, now also have war in the Middle East. And this is why I'm specifically making this video this week. I want to talk about how I, as a trader, profit from gold in markets with extreme volatility. What you need to understand is that even though gold is a safe haven asset, and one would anticipate that most of the money would be buying gold during the war like what we have now, often the volatility is two ways. We have the market moving both up and the market moving both down. In fact, gold has had a massive retracement on pricing during this major conflict. And a lot of investors and a lot of traders have been left wondering why. Why is it that when a typical safe haven asset like gold should be going up, at a moment of uncertainty and war, it is actually going down? Well, in this video, I'm going to break down exactly how I looked at the market during this uncertainty, how I've profited from this market, and I'm even going to share with you the exact trade setups that I've been taking, as well as looking at very specific market indicators that I've been following in order to understand the macroeconomic picture and understand how to profit from this volatility. The last couple of weeks have been incredible for me as a trader. Obviously, nobody likes war, but the truth of it is war brings about volatility, and volatility equals opportunity. If you're on the right side of the movement, you can make big money, and I am a huge advocate of gold and gold trading. I only trade gold. It's the only asset I focus on, and at least 14 hours a day, this is where the sole focus of both my investing and my long-term trading is focused. Gold is typically a safe haven asset, especially at times of war. However, this invasion of Iran by the US has been completely different. In fact, gold has seen a major sell-off during this war. I'm going to explain to you exactly why that happened in this video. I'm also going to show you where I looked for the opportunities and exploited those opportunities for profit. Let's jump in. Traditionally, the correlation between gold and the US dollar is pretty much inverse. So when gold, for example, is going up, usually you have the US dollar going down, and that's your typical correlation. So you can see very, very clearly historically where the US dollar is moving up, you can pretty much expect the opposite from gold. That is pretty much how gold has always reacted. Now, this last while, it has been somewhat different. In fact, if you go back to the late part of 2025, if you go to the very, very early part of 2025, we started to see an uncorrelated market. For the first time in pretty much the history of gold and the US dollar, we saw dollar going up, but we also saw gold going up at the same time. And a big part of that reasoning was because we have got both risk off and we have risk on sentiment. So with risk on and risk off, we've got some investors obviously seeking safe havens. On the other hand, we've also got investors seeking out growth. Now, one of the things that I have found particularly interesting with the movement of gold and the US dollar is that it is very clear out of Trump's administration that they desperately want to weaken the dollar for many reasons. But the biggest one, of course, is they want to bring manufacturing back to the US. In bringing manufacturing back to the US, they are obviously going to stimulate growth. They're going to stimulate jobs in the economy. And this is where the conversation gets interesting, because pretty much everything that Donald Trump and his administration have been doing have been around weakening the dollar. And unfortunately, the US economy has proved very resilient. So as a result, we've been seeing the US dollar continuing to go up. In fact, it has peaked a couple of times in 2025. And of course, in 2026, we've seen renewed strength in the dollar, despite the fact that Donald Trump and his administration is trying to intentionally weaken the dollar so that it brings about growth in the US economy. Growth in the US economy, of course, is going to be based on the fact that a weaker dollar means that some of the manufacturing that's traditionally been done in the East can now be brought back to USA. So this is where the story really starts to get very interesting. When this whole war started between the US and Iran, my immediate fundamental knowledge was to go and buy gold. That was my immediate reaction. Because remember that first and foremost, gold is a safe haven asset. So as a safe asset, normally what would happen, times of war and uncertainty, people would be buying gold and that would send the gold price up. Now I want to show you exactly what happened on the charts. Now remember, we went officially into the war at the end of February, so the very last day of February. Now I want to show you guys on the charts because this is really, really interesting. And this is where I saw the opportunity. I'm actually going to show you some of the trades that I took as well. So if we go and have a look at the charts, and I'm going to take you first and foremost to the daily naked chart for gold. So we're going to look at, you can see on the daily time frame here. And then I want to take you and I want to show you just a quick walkthrough of where we've been and what has changed. So here we have our all-time high. We've had that very big liquidity movement to the bottom end, obviously coming off a very, very overbought market. Then the market kind of moved sideways for a bit. And I was telling everyone this was reacting very similar to the way the market reacted at the end of last year when we broke that all-time high of 3,500. The market came down and consolidated between 3,000 and 3,100 for a considerable amount of time before it rallied back up. So once again, the market made this big liquidity sweep at the bottom here, and then went into a bit of sideways consolidation, even pushing up a little bit back into very strong supply and demand zones. We can see here lots of consolidation across the price, right? Now, if we go and have a look at this daily time frame, this is where things get interesting. I actually want to just stretch this out for you guys so you guys can see this. Okay, February 26. Have a look at where we're at, February 26. And I just want to show you guys. Here is the 2nd of March. Here is 27th of February. Now remember, this happened over a weekend. And so I remember sitting on the weekend and we heard that the US had invaded Iran. They had made the first attacks. And my anticipation, based on everything I know about gold, is that typically, based on any uncertainty, we should be looking for safe haven demand, and obviously the price of gold would go up. But something very interesting happened. So we go to that specific day. So there we go. We're on February 26th, right? February 27th. And then we go to the 2nd of March, which is the Monday opening. Now, I want to zoom in here so you guys can see this. This is where I knew something wasn't acting the way it always does. We had this pretty big candle here. And if we go and track that pricing, we went 5422. And then sold down all the way down to lower 5200s. Now that was super interesting to me because I looked at this and went, why isn't gold pumping more? Why aren't we absolutely ripping? I mean, we even had the engulfment setups here, the fundamentals aligned, everything we know fundamentally, times of war, gold is going to pump. Why did gold not pump? What happened here? And this is where, as a money tribe trader, we do things very differently. Seeing the Monday, after the war started, the attacks and the invasion started on the weekend, I could see that gold wasn't reacting the way I expected. We expected it to absolutely rip. And I'm going to show you in the trade logs. On that Monday, I actually took buys, but there were such quick scalps. I was scalping quick money out of the market because I was seeing this resistance in the market that wasn't making sense to me. And this is where, as a money tribe trader, I teach the importance of being a confirmation trader. I've spoken about the importance of having an if and or scenario. Most traders marry a directional bias and they stick with that directional bias and often land up losing money. The way we do things inside of the Money Tribe is slightly different. So what we do is we have an if and or scenario. What happens in these events if the market goes up? What happens in these events if the market goes down? Where is the liquidity going to flow? And once we have confirmation on which direction that liquidity is moving in, then we, once giving up 1/3 of the movement of the market to get our confirmation, we then jump in and trade. So Monday for me was very much a day of indecision. That specific Monday, just after the invasion. I couldn't see the movements at the top. There was resistance at the top. I could see price wasn't running the way it normally does. And again, I think this is part of the intuition of watching the market. Right, let's go back to the charts and let me show you how the story gets interesting. We have got over here, we've got the 2nd of March. That's the day after the invasions, the first trading day open on the market. And then have a look at this. Suddenly, over here, on the 3rd of March, the market completely had a meltdown. We went from 5376, and I want to be very clear, the market in the previous day was actually a doji candle, was in complete indecision, which to me again was just showing me that this market is completely uncorrelated to the way it should move. The correlation is times a war, the fundamental is that gold should be buying, right? Then all of a sudden we had this huge sell-off. The market went from 5380 and dipped all the way down to 4993. We were officially going below the level of 5,000. And this is where things got super interesting because I had a decision to make. I could either try and find the support level and I could look for that support level somewhere around here and potentially start buying. And had I started buying long term, I actually wouldn't have been too far off. If I'd bought that 4947 level to 50 to even 5,000, the market ran up another $200 from there. But what I was noticing is how aggressive the sells were. I noticed the movements to the upside were very quickly posting downside movement. This told me that something else was at play. And this took me to looking at the dollar and specifically what the dollar was doing in correlation to the price movements that we were seeing in gold. So I'm going to take you guys to the dollar chart, dollar index, and I want to quickly zoom out here so you guys can see this. We're going to go to, let's just put us on our daily time frame here. We're going to go to, let's have a look here, February 26, 27. Okay, here we are, March the 3rd. Okay, so that's March the 3rd. That is the Friday, we can see there, 27th. And then obviously Monday, the 2nd, we open up. So here's what's interesting. I had a look at the correlation here and I could see that the US dollar had been holding around this area for quite some time. You could see that it had been in an area of consolidation. But we had this very clear break of structure on the dollar. And here was what was blowing my mind. Despite this uncertainty, despite war, and despite the fact that we should have been seeing under war, we should have been seeing gold going up and we should have been seeing the dollar going down. That is what we would expect. We'd expect gold to go up and we'd expect the US dollar to go down. Instead, the very opposite was happening. What I saw was gold in a time of war was going down and the US dollar at a time of war was going up. This to me was the point where I knew something was very, very different about the way the market was moving. And this is where, as a trader, you have to just not focus entirely what's on the charts and always not what's necessarily in the news. What you have to do is decipher how the market is reacting, decipher how investors' money is flowing at these times of incredible change. And this is the moment I started focusing on the US dollar movements versus the gold movements. Now, having said that, traditionally we would always be doing this, but for about the last year and a bit, at least, there has been a complete disconnect. We've been seeing gold go up, we've seen dollar go up, we see the S&P 500 go up, everything's been going up. And this is the first time in a very long time we've seen the correlation come back, where we have the inverse happening between gold and the US dollar. And this to me was the moment I knew there would be a massive opportunity in the market. And this is where we need to talk about trader intelligence, because just because you can see the market doesn't mean it's the right market to trade. Coming back to the charts, and I want to show you guys, this was the moment I knew that there was going to be a massive, massive change in the market. Again, all I had to do was go back to, gold. I had to just correlate here what was happening between gold and obviously what was happening between the US dollar. And you can see from these huge candle movements, I mean, we're talking about 5380, it sold all the way down to 4995. So we're talking about over $400 of movement in that one daily candle. That is a massive liquidation. Then once again, it could have been very, very easy for me to simply have climbed in on the sells over here. But I was still very aware of the fact there was a very strong support structure historically over here. So what I wanted was a clear break of structure. And this is where things get super interesting, because when I started following the charts on the 5 minutes, and I'm going to try and take you guys all the way back there so you guys can see exactly what this looks like. There was this very slow and steady burn. There was this very slow and steady sell-off. The market was not reacting the way it normally reacts. And normally on a sell-off, it's pretty aggressive and it finds a point of support. But in this case, the market just kept selling. We could see we had this initial big movement down here, and I'm going to show you guys how we track the trend on the way down. I'm just going to quickly take us into 45 minute. The charts are unfortunately a bit too pinched for me to show you. But if you have a look here on the 45-minute chart, you can see that the moment we broke the support structure, the market sold, found a little bit of short-term support, the market sold, a little bit of short-term support, and the market just kept on selling. And what I realized, the moment we got to like the 4,800 level and we broke through that level over here, the moment that happened, I knew that this was not my fight. And the reason why I say that is because I understood that this was institutional selling, this was planned institutional selling, this was institutions moving liquidity from one asset class to another asset class. And it was very, very clear to me that the asset class that was favored from the US dollar based on the correlation of movement was, of course, the dollar. And if you go and have a look at the dollar, you will have seen how the dollar started to gain strength over that period of time. You can see the dollar really started to move up, breaking all of the moving averages, moving strongly to the top side, and once again, putting real pressure on gold to the downside. So I had a choice to make. The choice was, do I continue to trade this potential downtrend? Do I follow this trend down and make potentially a lot of money on the way down? Or do I potentially wait for a point where the market finds support and start looking to trade off of that support level? And here is where my thinking is completely different to the traditional retail mindset. The retail mindset is always about chasing the trade with the trend as far as possible. And whilst that makes sense in a normal run of circumstances, these were abnormal circumstances. This was a crap ton of liquidity moving around the market. And if you have a look, especially on the dailies, you can go to the hourlies and have a look at what this looks like. You can go down to the 5 minutes and have a look at what this looks like. These candles were big. These were big candle movements. In fact, if we come down to the 5 minutes, and this is again where I tell people trading is about far more than simply focusing on trading. You also have to understand the money management side of things. You have to understand how much liquidity you have to be able to pick a fight. If you go and have a look at these, and I just want to show you these candle movements on the 5 minute. We're talking about 4618 all the way down to 4585. We're talking about $50, $60, $70 candle movements here. Some of these candle movements, as we got to the crescendo moment in the sell-off, you can see these were, two candles. 4436 took us all the way down to 4300s. So we can see that these sell-offs were huge. And so I looked at this and I looked at the steady burn, and I was focusing very, very closely on the RSI levels on the way down. And something that became very, very clear to me is that the market wasn't selling off the way it traditionally does. The way the market traditionally sells off, it sells off pretty aggressively. And then what it does, it goes and finds an area of support. But this was not happening. It just was not happening in the charts. What we could see is that the market was selling off. It was finding a small area of support and then continued to sell. And this especially was very evident on the 5-minute charts during that trading period. And what we saw is days after days after days of consecutive selling. So we had this big break, then we went sideways for 4 or 5 days, and then by Wednesday the 11th of March, this market officially started to make its break. And then here by Friday the 13th, it was very, very much confirmed that this market was going to break its structure. We saw it first thing on Monday morning Asian session go into decision mode. And then we saw by Wednesday, it started to make these very big moves down. So once again, I had a choice to make. Do I ride this wave or not? And the reason why I decided not to take the trade, and it's the one thing I teach about trading gold, is that you need to understand order flow and you need to understand volume in the market. And order flow and volume are not always the same thing. There is order flow and there is volume based on the number of contracts exchanging hands. So I was looking very, very closely at the volume deltas. I was looking at contracts exchanged. And then I was also looking at the dollar index. And then I was also looking at the futures price. And everything told me that with the RSI levels where it was during this period, it was very, very clear to me that this was a slow and steady burn. And the only people who would know where this pricing was going to go to was the institutions themselves. And that was not my fight. Me with my measly little $1 million cannot go up against a 40 trillion market, or at least 5 trillion of money that was moving the market at that specific time. It wasn't my fight. I had to wait for the big dogs to do their sell-off and then eventually come in and find a level of support and start trading. And that's exactly what I did. On every move down here, if you go and have a look at it on the 45s and you go and have a look at it on the 5 minutes, what you will see is that there were always these moments of small little reversals. And the reason for that is because the market is a heartbeat. The market doesn't move one directionally. The market tends to move in a heartbeat. What goes up must go down. What goes down must go up. And you're always going to see this, right? So if we're going down, it's going to look like that. If we're going up, it's going like that. But it is a heartbeat. It cannot just drop straight. At some point, it has to make a move in the other direction. It is always going to do that. It is the heartbeat of the market. And the magic is trying to figure out when that happens. The magic is trying to figure out exactly when that moment is so that you can step in and potentially make profits. So what I was looking for those short-term pullbacks, those short-term reversals in the market. And that is really where I started focusing my attention. Obviously, hoping for the market to turn up way more aggressively, and then obviously to take those trades to the upside. So that is where I started to step into the market. Short-term buying, short-term scalping against the trend, right? Against this bearish trend that was very, very clearly in play. But having said that, this was a bearish trend within a much larger bullish trend. And I need to point this out because it's super, super important. I just want to quickly clear my charts here so I can show you guys exactly what I'm talking about. So if you have a look at this movement here, and this is really important to understand, we had the all-time high, we had a pullback, we had slight retracements, and then we had a continuation of this pullback going back and forming a lower low. However, in terms of the overall trend of the market, if you have a look at this overall trend of the market, I just want to remove these highlighters so you guys can see exactly what I'm seeing. This very much was still a pullback, and this market long term is still, without a doubt, still very bullish. Let me show you a bigger picture so you can see. All this was a pullback, a medium term to a short term pullback in this area. And the market is either going to go sideways for a while here, or it's going to move back up and it's going to try and break this all-time high. But one thing is certain, the market has to come back, find a strong area of support, and then it will continue. And that's what I was looking for, a strong area of support. And of course, that is exactly what I did. I started trading those short-term momentum movements in the market. I started focusing on entries in the 5 minute. I started focusing on those very short-term pullbacks in the market, and then looking for the opportunity for that trade to perhaps turn and run all the way up, which unfortunately it didn't. And obviously, as a consequence, I had to then start selling once we started reaching new levels of consolidation at the higher end of the market. So let's go and have a look at some of those trades quickly. So I want to show you guys. By the way, I share every single one of my trades that I take every single day. I don't take trades every day, but whenever I trade, I share this under a trade log inside of the Money Tribe and actually give my exact confluences and the reasons why I took these trades and exactly what those trades look like. And I share every single trade. Win or lose, I share them on here. So as you can see, March has been a very busy and productive month. So 2nd of March, you guys will recall that was the Monday. And like I said, you guys, that Monday, I came and I sat down and I was under the mindset with a level of bias based on historical pattern. It's war, and obviously, because it's war, we're going to be buying gold. So I started with, forget about what the charts told me. I had a fundamental bias of buying, and that's the first trade. You can see did not go well. We lost about $5,759, right? Day got a little bit better. I managed to claw my way back a little bit, but just short-term scalps. I was too hesitant to trade up against a short-term downtrend, but at the same time, I wanted to be with the long-term uptrend. That's why I was focusing on buying. And that Monday really confused the shit out of me because the market wasn't moving. It wasn't breaking the levels I thought it would break. And that's why you'll see I just continued to scalp. I continued to pull equity out of the market. So 11,000 pulled from that trade, 7,000 pulled from that trade, 5,000 pulled from that trade, and then obviously 5,000 lost on that trade. Now, if you go down and have a look, I gave my exact reasons where I was focusing on buying. I spoke about this huge gap that happened here. This huge gap that happened here was exactly what I expected to happen. We saw pretty much the war break out over the weekend. This was Friday's close of trading, and this market just absolutely, the institutional gap here was huge. And that gave me the confirmation that this market should be buying. But as I said, things didn't look normal. And so then we headed into Tuesday's trading. I want to quickly show you guys what some of those trade logs look like. So that was the second, that was the Monday. Now we go to Tuesday. Now I'm still kind of hunting around here in the early stages, taking buys. We're finding some good momentum. I'm letting it run down, thinking, listen, the selling's probably going to end now. I'm going to find my area of support. But I still was watching those movements up and the way the market was moving. And when I was looking at the volume deltas, I could see that something was off. And that's why I didn't hold these trades longer. Like I said, under any normal circumstances, I would have been holding these trades longer. So we pulled 11,000 there. This was a nice big trade. We got $38 of movement off the low of 5,076. Moved back up to 5,115, pulled $51,000 from that trade. Then we had another good trade at 21,000 and another good trade at 16,000. Now at this point, I was starting to see that the market was not reacting. It wasn't breaking big levels. It was having these stronger moves down, retracement moves up, which were the moves that I was trading because obviously I wanted to be with the larger trend of the market. And also I was not prepared to sell a market that was at war. But I had to change my thinking. I had to adapt to the market conditions because what I started to understand is that while traditionally war anywhere else in the world is probably going to signal buying for gold, which is what we've always seen, times of war, when America is involved, it's really fucking good for the US dollar. The US dollar, for America, war is a business. That is why America is probably always going to be at war. It is a business. It's good for the US dollar. It's good for the US economy. And so with oil prices starting to shoot through the roof, with the dollar just gaining so much strength, you can see I then went to the 4th of March, and then I had no trades on the 5th of March because, I was really just trying to figure out what the fuck this market is doing. At this point, I was still buying the short-term reversals simply because I wanted to be with the larger trend of the market. So on this trade, we pulled $29,000. And for those of you who don't know, I trade a master account and copy to a slave account. There's a whole reason why I do this. But I focus on this account. So I'm focusing on, can I pull $5 from the market, $10 from the market, and I layer it on with my slave account. And I obviously go with much bigger lot sizing because there's bigger equity behind that as well. So once again, only one trade here, just sitting on the market, trying to figure out what's going to happen. And then 6th of March steps in, right? 6th of March, 2 trades. And I started to shift slightly to a sell side bias, right? I could see the market wasn't running. I was keeping a very close eye on the dollar. I started scalping those short movements. And we can see here, pulled $12,000 out of the market. And then, bam, a nice big trade, $68,000. And this is where I really started to focus on the fact that, listen, this market has shifted. I need to shift. I obviously need to look at things slightly differently. Now we go into the 9th of March, 10th of March, and 11th of March. I'm going to show you guys quickly. Sell side bias stepping in, right? Sell side bias stepping in, another $39,000 there. Sell side bias stepping in, another $29,000 there. And you can see these are all very, very, very similar price movements, right? If you go back to these trades, it might look like the same trades, 15.59 over there, 15.68 over there. I sold at 5158 over there. I sold at 5086 there. But I was targeting these little consistent movements. I started to see the pattern in the way the candles were moving, and I knew that I could get in there and get myself a guaranteed $10 or a $15 movement. Later on with my slave accounts, which I started to actually increase the lot sizing because I built equity, $29,000 a trade, $29,000 a trade, $19,000 a trade, $22,000. Now you can see I'm selling at this point. So this is at the 11th of March, right? We can see I'm still figuring out exactly what the market is doing, but starting to make slightly bigger moves as I'm trading with that short-term downtrend. And obviously being very aware of the fact that I was not trying to target more than $40 or $50 of movement in the market on either direction, purely because I knew this market could turn very aggressively very quickly. So now we go into 12 March, 12 March, 12 March, and you'll see here, still sell side. Took a loss over here, $2,300, recovered nicely, $11,000 in the next trade, and then a nice trade at $25,000. So what you guys can see is I'm just touching the market constantly. I'm just constantly going in and having a look here and saying, listen, where is the opportunity? Where can I find the imbalance in the market and trade the imbalance? Because truthfully speaking, I just don't have the equity with my measly little $1 million trading account to go up against a 40, $50 trillion behemoth with $5 trillion in trades moving around at any given time. So here I am focusing on these downtrends, and we're just going to show you guys here exactly what that looked like. So I was focusing on how does the market move down? Where does it find support? Where can I trade the imbalance? And obviously, I'm always looking for that V pattern for a potential reversal. I'm going to show you guys on the charts quickly. So potential V pattern, what am I looking for? For reversals, I'm always looking for where does the market form this V? And obviously, where do we have the downtrend being broken by a potential uptrend? So this is what I was doing. And I was saying, okay, here is an area of imbalance. Let this market trade up. Let me let it run up. As long as it doesn't break a previous structure, let me sell off those levels. So this is where I started focusing my attention. Retracement, resistance, sell off. Retracement, resistance, sell off. That is how the market was reacting. So this is exactly what I was looking at in terms of imbalance. I want to highlight the fact though, at this point, I'm really concentrating on fundamentals. I'm reading everything there is on the US-Iran war. I'm understanding what military capability Iran has, what military capability the US has, understanding the economic impact on oil, the close of infrastructure allowing oil to flow. And all of this led me to believe that the dollar, despite all the intentions of Donald Trump wanting that dollar to come weaker, the dollar was going to continue to pump, because the one thing that an investor always seeks out is a return on asset, a return on invested capital. And that wasn't going to happen in gold. People saw the opportunity in the US dollar, people saw the opportunity in oil, and what we had is we had liquidity flowing to those assets, and liquidity not totally flowing out of gold, otherwise we would have seen a more aggressive sell-off, but some money being taken, some profits being taken from the institutional levels and redeployed and redistributed into the US dollar and into oil. Right, so we are selling retracements, and we're letting the market retrace. We are selling those retracements, and we're focusing on those potential down moves, right? So here we can see still making nice profits, a loss every now and then, but the losses are pretty contained. Now we get to 16th of March. Now things are getting to the sort of crescendo moment. So 16 to 19 March, okay? Here we go. We've got a big loss here. I was selling resistance. The market moved against me very quickly, had a lot of slippage on this trade. I had all the right conferences. Everything was correct. I knew my directional bias was direct. And you can see all my conferences that I had here. But the market just moved against me because, again, lots of liquidity moving in those candles. And obviously took a hit, $24,000. Next trade, I came back literally, and I want to show you, 5023 is where I sold. 5014 is where I sold. So I waited for the market to go up slightly higher. It stopped me out, and I let it run a little bit, find the next level of resistance, which I knew I was selling the resistance of the retracement, and I came back with a big win, $53,000, which put me into net profit for the day. We then came with a second trade, $47,000 on the 19th of March, another big move there. Again, another big move here, $50,000 almost, and then a $60,000 move. And what you will notice by now is here we had been focusing on selling, and all of a sudden over here, we shifted our attention back to buying. Why did I shift my attention back to buying? Well, if you have a look here, we're at that key decision level of 4,850. I spoke about it extensively in my tribe and in my community and in my daily market analysis. I said, that is the level we either find support. If we break down below this, we're going to sell a lot more aggressively, in which case I'm going to let the institutions sell. I'm going to let that market run until I find support, and then I will find my big trade. And this, by the way, ladies and gents, 19th of March is where I found that big trade. 4614. I let that market run down. I let it find a little bit of a strong bottom, and we traded off of that for a very healthy $60,000 trade. And you will notice that I increased my lot sizing. I was so confident of this trade. I was prepared to take, on the downside, I was prepared to take like maybe $6 of loss on this trade, which would have equated to, I don't know, maybe, $8 or $9, $10,000. But I knew that the upside was far greater. I increased my risk on my slave account, $60,990. And then we come to the last couple of days of trading. So we're going to go 20 March, 23, 23, 23, 24. And I just want to show you guys what the tail end of this month looks like. Big trade here. Selling once again off that 4405 level. We've seen the market shifted down further, came back up. Once again, just working off retracements, focusing on the retracements and looking at those retracements as an opportunity to trade with the directional bias, obviously the strongest directional bias. And you can see over here, literally just following this pattern, letting the market find its V shape, letting the market make its retracement and find an area of resistance and look for the continuation of the downtrend. So this was continuation until we started to get to a place of market exhaustion. And we go to the place of market exhaustion, we can see this became very, very, very clear as we headed towards, the 20, let's just pick up the exact date here, 23rd to the 24th. We could see the market once again making a very, very strong bottom, continuation of the lower lows, but then we had this retracement and lots of sideways movement, which usually indicates accumulation after these very, very strong moves. So we usually get consolidation at the top end of a move, and we usually get accumulation at the bottom end of the move. Why? Because the market is a heartbeat. That which goes down must go up, that which goes up must come down. And once you understand that principle and you understand how to align that with the fundamentals, you can find those entries. And this is how it turned out for me. So $85,000 trade. Once again, you can see increasing my lot sizing. We took a $30,000 loss there. $92,000 on this trade. Obviously, you'll see the dollar movements are pretty healthy there. We had a $30 movement. Very happy with that. Targeting $24,000, $44,000. And obviously, you guys can see where I shifted from sell side to buy side bias. Once again, all of these trades shown specifically in my trade logs. Quick little break out of the office, and we're going to go play a little bit of tennis. Trying to do as much sport and be as active as possible. So I try not to be sitting at the desk too much all day. But as you guys can see, there's a lot of desk work that goes into what we do. So I've got Andrea playing sport finally. Eh?
Undercover, okay?
Excited, right?
Not really.
This area for phone and beverage.
Okay.
Yes, and we have 6 courts. Below is 1 until 3.
Yeah.
And upstairs 4
Yeah.
until 6. And this one for this room and toilet shower we can.
Okay.
Yeah.
Perfect,
Okay.
thank you very much. So one thing I will say is that the sports facilities in Thailand really are amazing. Obviously pay quite a bit of money if you want to have a game of tennis.
Yep, you go.
Couple of grand.
Turn right and upstairs. Court 4, 5, 6.
Same thing with
I am number 5.
Yes.
golf.
On the middle. Yes, I'm golf.
Thank you very much. Thank you.
Enjoy.
Bye-bye.
No, that's a coincidence. I was talking about golf and he said his name is Golf. Anyway, so whether you're playing golf, whether you're playing tennis, whether you're playing badminton, like it really doesn't matter. Like paddle, you have to pay to enjoy sports in Thailand.
But they keep the facilities immaculate.
But have a look at the spot. I mean, it's
You get
beautiful.
showers, you get everything.
And this club is a really nice club, by the way, all privately run. So there's no like municipal or government facilities like that. So everything is private. You can see all of it is covered indoors because obviously it's very hot here in Thailand. So also a lot of rain during the rainy season, so they tend to cover up the courts and cover up the facilities so that you can actually enjoy it. But yeah, what a magic spot, right? We're gonna play a little bit of tennis, probably very badly, but the most important thing is that we're out here, we're moving, we're staying fit, we're staying healthy, and my goal is to be the fittest 50-year-old on the planet. So every day we're doing something, every day we're doing sport, and you're gonna be the fittest 30-year-old.
Wait, hold on, how does it go?
Oh my Lord.
Okay, show me. You're
Thank you.
such a big know-it-all.
As you guys can see, trading is about a lot more than simply looking at the charts. It's more than simply following the old patterns and the old rules and saying, well, because gold has always done this or because the dollar's always done that, I'm going to trade these rules. Trading has to be dynamic because the world is dynamic. And the one thing I'm always trying to teach people about trading is that we look at the fundamentals as the basis of every decision we make. We then use technicals in order to execute and find the best possible setups. But it has to be in alignment with our fundamental bias. So the best way for me to explain this is I look at what's going on in the world, I form a thesis and a bias, and then I simply come and sit on the charts and wait until I'm right. And if I'm not right, if the market actually goes in the opposite direction of what I'm anticipating, I don't simply change directions. I start paying attention to why that is happening. Because as a trader, your job is not to predict the market. Your job is to understand how it moves. And once you understand how it moves, you can then correlate that into profits. Sometimes the best thing to do when the market is making moves that you don't understand is simply to sit and observe. So we're going to go back to my computer quickly. I want to show you guys exactly what I'm watching right now until we break out of this current trend, which is this short-term to medium-term downside trade where we have literally done a pullback, a little bit of consolidation at this level. Now waiting to see, is it accumulation or is it consolidation? Because the market has pretty much gone into a phase of indecision once again as of when this video has been made. So let me show you guys at some of the things that I'm looking at and what I'm going to be paying attention to specifically in the up and coming weeks when it comes to gold. The very first thing that I'm looking at, and this is super, super important, is I'm looking at this dollar index. The dollar index for me is literally going to be the everything in my decision making until the current trend breaks, until this trend has completely changed course. I'm going to essentially be focusing entirely on the dollar index as one of my major decision-making factors. Now, obviously, I'm correlating that with what's going on in the real world. Are we seeing ceasefires? Are we seeing peace talks? Are we seeing any negotiations? Are we seeing NATO being drawn into this? What is happening with the oil price? Like, that is something else that I'm tracking very, very actively on a daily basis. So very, very actively. I just want to turn off our key levels on here so you guys can see this. I'm tracking the dollar pricing. Now, again, I'm not looking at the dollar pricing alone. I'm looking at dollar pricing versus oil. And then I'm also looking at how is oil and dollar moving relative to what's going on in the real world. Not the news, the actual data, the actual wartime data. Because every time Donald Trump opens his mouth, the market moves based on sentiment. What we're really interested in is how is the market responding, not just to the sentiment, but the fundamentals. So first thing I'm paying very close attention to is the dollar index. The dollar index for me is a very, very, very important part of making my decisions in terms of trading gold at the moment. They are directly correlated. So what you can expect for the next couple of weeks is that if you see the dollar going up, don't immediately go and place trades based on this, but it helps you form your bias. If the dollar's going up, you can anticipate that gold is going down. Now, at some point, we're probably going to see that correlation break. This has been broken for most of 2025, the late part of 2024, but we're starting to see that direct correlation between gold and the US dollar, that inverse relationship. So if you see the US dollar going up, go and have a look at gold. If gold is moving down, then you have an idea that this market is correlated and moving exactly as you would expect. But you have to ask yourself the deeper question, why? And the answer to this question is very simple. If money is flowing into the dollar and into oil, investors are seeing that as a bigger opportunity. That is where money is flowing to. And then consequently, what we're seeing is some of a sell-off on gold. We haven't had a full-blown sell-off. We've just had some liquidation on gold because that money is being diversified institutionally into US dollar-based transactions, US dollar-based investments, US dollar-based monetary flow, right? So I'm going to be looking very, very closely at the dollar index, DXY. And I specifically only followed on the daily chart because anything else in between is going to be noise. I'm also focused on oil, and I'm focused also on oil on the daily charts because that is going to give me the most true reflection of what is happening with pricing. We can see we're at a very key decision level at $92 at the moment. We can see the market is waiting to make a decision. Have a look at the dollar. We're starting to see a very similar correlation over here. Have a look at this. We are in an area right now of consolidation, which is, a better way to explain that is the market has indecision, okay? Then we come over here and we're seeing very much a similar thing. If I pinch this a little bit more, it will look a lot similar for you guys. You can see the market is at this level of indecision, 99 to 100. The market hasn't quite decided what is it going to do. And then, of course, if we come across and we look at gold, let's take that into our dailies over here. What you will see is you'll see a very, very similar pattern. Although we look like we are continuing to sell, what we are starting to see here is we're starting to see a little bit of sideways consolidation. So I'm going to be focusing on dollar index. I'm going to be focusing on, of course, oil futures. And then the last one I'm looking at is actual gold futures to understand how longer term the industry and the market is positioning against these current movements. So if we have a look here, futures is very much tracking the pattern that we're seeing on spot, a very, very similar pattern. But if I see any major directional changes, spikes in pricing, or if we see a sell-off, of course, on futures, that tells me that the institutions are starting to price gold differently. So the part that I really want you to take from this video is that it is not all about technical trading. It is about reading data. It is about consuming news, understanding that fundamentals is about what is really happening in the world. News is often after the fact, which is sentiment driven. And then we have the technicals, which is confirmation for entry. If you have got sentiment and you've got fundamentals aligned with technicals for entry, you can make money, as you've seen. The problem is most people are coming to the charts and only looking at the charts for trading. And they're making their decisions based on historical data. What you need to understand is that nothing we do is based on prediction. What we are doing is trading based on probabilities. And whilst the charts historically provide the price movements of gold and therefore are potentially giving us a signal of where the market could be going, that could be thrown right out of the woods the moment the fundamentals step in. So fundamentals are always going to give the directional bias. Sentiment is going to offer up short-term confirmations of that. And then finally, technicals are going to give us our entries. And when it comes to technicals, I think this is where so many people are failing in trading. They purely come to the charts every morning. They look for those price action movements. They look at their indicators, but they are completely disconnected with the real fundamentals that's going on in the world. And by the way, news is not fundamentals. News is a lot like the charts. It is based after the fact. News never reports before the fact. It always reports after the fact, which is why most people are trading completely reactionary. They are reacting to what's happening in the market by trading only the charts and only trading news. Fundamentally, what you want to do is you want to have your fundamental biases based on everything that's going on in the world. So as an example, I was very, very keen on selling, but I chose not to sell because everything on my fundamental knowledge told me that even though the dollar was strengthening, we're still at times of war, and it would be foolish for me not to pay attention to the longer term higher trend of the market. I flipped that when I started to see the market breaking below key areas of support and those areas of support becoming resistance. And this is why I say it's really, really important to pay attention to the fundamentals, because those flips that happen in the market, those points of big market momentum shifts from the downside to the upside, those pivotal moments in the market, those don't happen because of something technical. Those happen because there is something fundamental. And one of the ways I always profit out of trading and why I'm so consistently profitable is that, first of all, I always concentrate on aligning fundamentals, technicals, and sentiment to get the most favorable trades, and therefore being patient enough to wait for those trades. And secondly, having really good risk and trade management. You guys will notice when I lose very little. When I win as much as possible. At the same time, I'm not greedy and I don't hang on to trades too long where they could potentially reverse and land up becoming a losing trade. So I really hope that this gave you a huge amount of insight in how to trade, how to look at the markets during times of volatility, to not simply have one simple bias, but to be open to the if and or scenario. As a trader, I've made a lot of money out of just giving up 1/3 of the potential movement of the market as a confirmation and trading the second third of the move for guaranteed profits. If you are interested in learning how we trade inside of the Money Tribe, it is a brilliant system. We are entirely focused on teaching people to go back to fundamentals. We're really teaching people old school trading with all the new tech to aid us in terms of, making better entries, better risk management, better trade management, better decisions. If you are interested in that, you can check out moneytribe21.com. So end of another day. I hope you guys enjoyed the video. I hope you enjoyed the breakdown of the way I see the market. We've come into a little cigar lounge here close to us. It's one of my favorite little places to come and sit and relax. Also a great place to meet people. Very, very good networking spot. And we're going to enjoy a little cohiba and obviously wind down from the day. I think if you had a very close listen to what I had to say in this video, I think you will understand that gold is an incredible opportunity. But just like anything else in life, you have to do the time, you have to put in the work. But more importantly, most of what you're going to discover in the gold market is the opportunity lies in the fundamentals. And I think too many people are focused on the technicals. The real opportunity is understanding the macroeconomic picture. So I hope that you guys have enjoyed the video. Something a little bit different for the channel. I obviously want to bring a lot more of this kind of content to the YouTube channel. I hope you've enjoyed the breakdown about how I think and how I look at the market. Obviously, this is the end of the day for me here in Phuket. We're enjoying a little bit of a cigar here in one of my favorite cigar lounges. And this is a great place to meet people, great place to network, but also more importantly, a great place to just really sit and reflect. And I come here fairly regularly to sit and just reflect and wind down from the day and really just think about how I'm positioning myself in the market. The market requires a lot of patience, requires a lot of thought, requires a lot of strategic planning. And so I think these quiet reflective moments are an absolute must. I hope you've enjoyed the video. Let us know in the comment section down below if you'd like to see more trading related content like this, if you'd like to see deeper dives, and if you'd like to see me bring more of this content to YouTube. If you guys enjoyed it, make sure you hit that like button and obviously drop a comment down below.